And let's shift focus to a corporate then, GIC RE. It reported its numbers a couple of days ago, and gross written premium saw an uptick of a solid 18% on a year-on-year basis, while net written premium saw an uptick of 19%. Profit, however, had declined by about 17% on a year-on-year basis. And to discuss the results and the outlook going forward, we now have Mr. Ramaswamy Narayanan, CMD at GIC RE, now joining us. Mr. Narayanan, thank you so much for taking your time out and joining us here on ET Now. Combined ratio went up in the fourth quarter drastically from about 89.26 to 103%. Tell us what led to this loss in the quarter gone by and what's the outlook going forward for FY26?
So basically two areas. One is property, and this is foreign property where, if you remember in the first week of Jan, there was a Los Angeles wildfire. So basically, we got some losses from there, but we have also provided quite conservatively for this. We've actually provided about $150 million for this. Currently, I have received only about $38 million of advices from my business partners. But then we wanted not to have a shock in the balance sheet at any point of time. So we have provided for it. So that is one thing which has hit us. Secondly, where we have gone up a little on the claim ratio is on the life side, where we have, again, this is not due to any losses, but more due to provisioning that we have done to ensure that, as you would appreciate, life is a long-tailed class. It goes on for very many years. So we have only made some provisions to ensure that in the later years, we don't get any shocks due to losses coming in.
Hi, good morning, Mr. Narayanan. This is Ankita also joining in. Tell us, is this elevated claim trend a one-off, or do you expect this to persist in FY26 as well?
Now, if you look at my results on an annual basis, at the beginning of last year, I had said that after 2 or 3 years of consolidation, we have started our growth journey and we should be growing around 10%. So we have actually achieved that. We have grown 10.72% this year. Also, at that time, investors wanted to know how would we plan to go closer to 100 when it comes to our combined ratio. Now, while our combined ratio by itself at 111 last year gave us an adjusted combined ratio of 87% when you add the income from policyholders funds, but GIC has always wanted to come closer to 100 when it comes to combined ratios. So I had given an advisory that every year we would typically shave off 2 ratio for maybe the next 3 years, and then maybe for the next 5 years we would shave off 1% from our combined ratio and reach 100, because it's a journey. It's not something that you want to do in 1 year and then come back to 111 again in the next year. So if you see this year, we have actually shaved off 3% from our combined ratio. Our loss ratio has gone down by 4%. Combined ratio has gone down by 3%. My profit before tax has grown by almost 15% year on year. This is actually a record year for GIC in terms of profits, because profit before tax, we have reached about 8,765 crores. In the history of GIC, in its 53-year history, we have never touched this figure. So it's an exceptional year for GIC. So just looking at it from a final quarter results, I don't think makes sense. We need to look at it annually.
Okay, so that's the picture as far as claims are concerned. But Mr. Narayanan, investment income for the quarter also rose by nearly 32% on a year-on-year basis in the fourth quarter. What led to this, and what actually contributed to this, and what's the outlook for the next few quarters?
This is because we didn't, so normally our investment income consists of two incomes, so to say. One is the fixed income interest interest and dividend that we get on our investments. Second is the profit on sale of investments that we do every quarter, every year. So this year, as you would know, it has been a very volatile year. The market has been going up and down. So rather than selling and booking profits, we actually thought this is a good idea to actually buy. So when the markets were down, we have actually bought more securities. So in that respect, our overall investment portfolio looks very good. But then compared to last year, we did not sell as much of investments as we would have normally done in a normal year. So which is why if you see our profit on sale of investments have come down a little, whereas the income from fixed income fixed income securities have actually gone up. So actually, it has been a good year. We have de-risked our investment portfolio also very well.
Right. Mr. Narayanan, so do you foresee any pressure on the investment returns in FY26 due to the global interest rate volatility or any market correction?
Not really, because our fixed income is held to maturity. We don't trade on it. And what we have done is, as we have seen interest rates slowly going down, we have actually locked up our investments in high interest rate securities for 10, 15, 20 years. These are the long-term securities that we have bought and kept in our portfolio. So even as interest rates come down in the coming years, I think what will change is only the new investment that we do, which will be, compared to the overall portfolio, the book that we have will be very small. So I don't see any shocks hitting the investment book. As I said, we have been trying to de-risk our investment portfolio a big way. And actually now we are seeing the effect of that in a very positive way.
Okay, and are you planning to revise your product mix or reduce exposure in high claim areas like agri and health? And any price hike in any of these segments due to global challenges that is likely in the foreseeable future?
Well, not really. So every piece of business that we write, if you see, has an element of risk and has an element of high risk coming in due to high claims. It is our responsibility to ensure that our underwriting is good enough to manage that exposure and manage the claim ratio, and that is what we are doing. If you see in those 2 3 years of consolidation that we did, that is what we did. We studied our portfolio completely. Those pieces of business which we were clear that it is not going to make money for us, we just shed it. We know that every piece of business at some point will have loss, but overall, in a long term scenario, say in 5 years, 10 years, it must make money for us. As long as it does that, I think we are fine, we are good to go. I think currently the portfolio that we have is very good. It should give us better underwriting results going forward.
Right. Also, Mr. Narayanan, tell us what percentage of your book now comes from the international markets. Are overseas operations also seeing a higher claim? Also, given the current global scenario, what is your outlook on the international business?
So to your first question, our current international book is about 25%, 75% is domestic. And that is simply because if you remember, for writing international business, we need to have a good international credit rating, which we didn't have till last year. So last October, our AM based international credit rating got upgraded to A minus excellent. Now that means that now we can access good quality business in the international market, and typically, international business happens on the 1st of Jan in a major way. So this 1st of Jan in 2025, we got to see a lot more business from the international market, and we wrote comparatively big lines also. So we have grown by about 25-30% on 1st of Jan compared to what we did last year. So we are very confident about our international book. We have some great relationships there. We have some great business partners with whom we do business. And we believe this business will definitely be profitable for us going forward. So we are very confidently now moving ahead in the international market as well. But we are very careful about the business that we write. We don't typically write long tail classes there like motor third party or liability. It is more property, engineering, marine, and those kind of classes. And we are very confident that these classes will work well for us.
Okay, so the outlook for international business is very positive. But Mr. Narayanan, how much impact have you seen in the fourth quarter on account of rise in property insurance rate with effect from January 2025? And has the hike in property rates impacted you, benefited you? And what's the outlook with respect to pricing going forward?
So that is definitely good, and that is something where GIC has played a big part in trying to kind of counsel and make insurers understand the need for having a proper rating mechanism and ensuring that the right pricing is given for the right risk. So from 1st of Jan, it is stabilized. Even on 1st of April, we have seen it stabilizing. So we are very optimistic about it. Obviously, we are closely monitoring it because we don't want a situation where suddenly it goes down like it happened last year. But we are closely monitoring, and I think because of that, the overall premium figures for property in India will definitely go up, and that is good because for the kind of catastrophic risks that we are seeing in this market, you need to adequately price for that. So I think that's a good thing that is happening.
All right. Also, Mr. Narayanan, I'd like to understand if IRDAI has been gradually reducing the obligatory session percentage currently at 4%, same from the last 3 years. But if it is reduced further or withdrawn, how will this impact GICRE's premium flow and underwriting strategy as private insurance companies are demanding it?
So what is happening is, I don't think any of the insurers are typically saying they don't want obligatory sessions. All they are saying is, the terms for the obligatory sessions should reflect the profitability that each of these companies are bringing into the market. And we are agreeable to that. In fact, we have been making representations to IRDA saying that, the obligatory sessions terms should not be fixed by IRDA. It should be allowed for us to fix it, because we understand how to do that. We do business with all these companies, so we know how to fix terms depending on how they write business, how good they are in underwriting the business. So that is where it is. Going on to your question about whether the reduction in obligatory sessions will affect us, honestly, I don't think so, because the way we have planned our strategy, even this year, if you see, the overall insurance market for 24-25 grew by about 6.2%. So you would say that the obligatory would also grow by that. Whereas if you see my other business that I write in the Indian market, I grew that by about 25%. So obviously we are not depending on obligatory. I think obligatory is a good piece of reinsurance program to have in the market, because new companies can take advantage of that. And it's also a way of ensuring that insurance premium remains in the market. You don't want premium going away to foreign markets. So that is why IRDA is also keen on continuing with these obligatory sessions. I think finally what we need to understand and do is ensure that every company which is providing obligatory sessions gets terms, commission terms, depending on the underwriting profits that they generate in their books.
And Mr. Narayanan, if you can give us some growth outlook for FY26, any growth number that you can share with us with respect to guidance going forward?
It should be around 10%, because first Jan, like I said, we grew by about 28% our international book. That obviously is at a smaller base of about 10,000 crores. We have grown by that. In the domestic market, we grew about 8% on 1st of April. So I believe overall we should grow by about 10%, say about adding another 4,000 crores this year to the top line.
All right, Mr. Narayanan, thank you so much for taking the time out and joining us on the show. We will let you go on that note.
If you like this video, then like, share and subscribe to ET Now.